Okay, let's just jump right into it. Welcome to today's Explainer, where we're going to put on our financial analyst hats and really take a deep dive into a massive macroeconomic shift. We're looking at Bangladesh Bank's highly anticipated May 2026 e-loan policy rollout. If you've been following digital banking growth, you know that creating a totally frictionless environment for consumers, that's the holy grail. But doing it at a national scale under the watchful eye of a central bank, well, that introduces a fascinating mix of risk, regulation, and tech innovation. So today, we're breaking down the mechanics of this fully digital lending service, pulling the data and the structural plans straight from the source.
50,000 taka. Under this new policy, a consumer can instantly secure up to 50,000 taka without ever stepping foot inside a physical bank branch. I mean, think about that for a second. No taking a half day off work, no sitting around in stuffy waiting rooms, and definitely no massive stacks of paperwork. Just, boom, rapid, instant liquidity right to the borrower. This is literally a monumental shift in retail banking strategy. We're moving away from that old branch-centric lending and heading straight into a purely customer-centric, digital-first model. So how exactly are they pulling this off? Well, here's our roadmap for today. First, we'll look at the digital loan rollout. Then, the 6-month pilot workflow. After that, security and local data. And finally, banking impact and inclusion.
All right, let's kick things off with Section 1, the digital loan rollout.
So, these e-loans are designed with a maximum 12-month repayment period, and it's managed entirely via digital platforms like apps or the web. From an analyst perspective, this tells us a whole lot about the product's DNA. It's a short-term, high-liquidity product. The central bank is basically encouraging a rapid turnover of capital here. By keeping that repayment window super tight, capped at 1 year, and forcing the interface to be 100% digital, banks can manage their risk profiles so much more dynamically. It's all built for rapid, seamless repayment that perfectly matches the speed of the initial payout.
Moving right along to Section 2, the 6-month pilot workflow.
Now, you don't just flip a switch and change national banking overnight, right? This whole thing kicks off with a crucial pilot phase to test this 3-step workflow. Step 1 is a purely digital application. Step 2, CIB verification. And Step 3, instant disbursement. But you know what's really important here? It isn't just the steps themselves, it's what's actually missing. Notice how there's absolutely no manual underwriting review step that drags on for 3 to 5 business days? Yep, the entire pipeline is built from the ground up to be completely automated and totally frictionless.
Of course, to mitigate the really obvious risks of instant lending, we've got the CIB, the Credit Information Bureau. Basically, this instant background check is the absolute critical gatekeeper here. To even qualify for that 50,000 taka, the applicant cannot be a loan defaulter. So by plugging the CIB database directly into this instant digital workflow, banks can rapidly filter out any bad actors and keep their loan portfolios healthy, all without slowing down the process for the actual legitimate borrowers.
Okay, let's pivot to Section 3, security and local data.
So historically, traditional loans relied super heavily on physical paper documents and, actually visiting a branch for verification. It was incredibly slow, but hey, your physical presence was the security. These new e-loans, though, they ditch the paper entirely. Instead, they lean on biometrics and local data centers. The central bank is essentially swapping out physical friction for advanced digital cryptography. You aren't proving who you are with some blurry photocopied ID anymore. Your own unique biological markers are the things actually authorizing the transaction. Pretty wild, right?
And it's not just biometrics. The policy also strictly mandates 2FA, or two-factor authentication. For anyone maybe a bit newer to digital security architecture, 2FA is basically a secondary digital step you have to take to authorize the loan. It means that even if someone, somehow, bypassed your app password, they'd still need a secondary temporary code, which is usually texted straight to your physical phone, to actually trigger the disbursement. It's all about making sure multiple solid layers of cybersecurity are protecting your financial identity right at the moment of the transaction.
Let's see how all this stacks up into the complete security infrastructure. We've got strict cybersecurity protocols, the biometric authentication, and that 2FA requirement we literally just talked about. But honestly, the real standout requirement here is that top bullet point, local data centers. This is a massive, massive regulatory detail. The central bank is drawing a line in the sand, mandating that all this incredibly sensitive financial and biometric data has to live in local data centers. Why? Complete data sovereignty.
This ensures Bangladeshi financial data stays strictly within the country's borders, subject only to local laws. It's a huge moat that protects the national banking architecture from international cyber threats during this big rollout.
Which brings us to our final part, Section 4, Banking Impact and Inclusion. Let's break down the core financial mechanics for the banks themselves, because it's pretty clever. If a bank uses its own market-based funds to issue one of these e-loans, they're free to charge a variable market-based interest rate. Fair enough. But, and here's the kicker, if the bank uses the central bank's refinance facilities to fund those loans, the interest rate they can charge the consumer is strictly capped at 9%. This is just a brilliant lever by the central bank. It lets banks play freely in the open market, but it also creates this highly attractive subsidized safety net, capped at 9%, to make sure liquidity stays super high and credit actually keeps flowing down to the consumer level.
And that leads us to the absolute core analyst thesis of this whole initiative. This policy is explicitly designed for complete remote processing to drive financial inclusion. Seriously, if you only take one thing away from this explainer, make it this. This is not just some flashy, convenient new app feature for folks who already have like 5 credit cards in their wallets. No. By completely removing the need for physical paperwork and branch visits, Bangladesh Bank is making a huge structural move. They are bringing unbanked and underbanked populations, people out in remote or rural areas who historically just couldn't access formal credit, straight into the formal digital economy. It is literally democratizing access to capital.
Which ultimately leaves us with a pretty provocative question. Will complete remote accessibility entirely replace the physical bank branch in Bangladesh? Think about it. As this pilot expands and 50,000 Taka loans are just flowing instantly through biometrically secured local data centers, well, the necessity of brick-and-mortar banking kind of starts to vanish, doesn't it? We're watching the real-time evolution of a digital-first economy. This e-loan policy, it isn't just about borrowing money. It's about fundamentally rewriting where and exactly how banking happens. Thanks so much for joining me for this analysis.